Welcome back to Inner Circle Precision. In this video, we are going to be talking about a powerful trading strategy utilizing the ICT Daily Bias. In this video, you are going to learn about 1. Using draw on liquidity to map next candles. You are going to have a higher probability of predicting the next daily candle with high precision. 2. You are going to learn about the daily market entry using the power of 3. So it's basically to utilize the draw on liquidity, map the next candle, and be able to enter that next candle using the power of 3. So basically we need to start by defining what draw on liquidity is. So draw on, in layman terms, this can be defined as the magnet of the market. When the market is moving, it likes to go to several points, but those points are not just random points. These are the liquidity points. The market feeds on liquidity and it always moves towards those liquidity points. We need to first note those liquidity points before doing anything as explained below. So the daily candles draw on liquidity is actually defined by this rule of thumb. We say whenever we see a candle low being broken and price closes below that low, we expect the following candle to take the low. It might be confusing, but if you repeat what I've just said, you actually understand it. We can see that on this particular candlestick, this is a daily candle. It is this high and this low, right? So in this particular instance, we had a candle closing this as a bearish candle. The following candle actually wicked here, but since it actually closed below this particular low, we will be expecting that the following candle will actually take out this low. Is what happened. This candle took out this low, and this candle, we expect that the following candle will also take out its low, right? It took out this low, although it ended as a green candle, but what we are interested in is to be drawn to the low of the candle that has broken the low of its previous candle. If you master this rule of thumb, you will be able to cover half of the concept that I'm trying to put across here. All right, so basically after doing all that, we now need to understand the power of 3. Basically, the power of 3 is stating accumulation, manipulation, and distribution. This is the arrangement of price movement within the day while trying to achieve the liquidity zone. We've seen that whenever a candle breaks this low, right, we expect the next candle to break this low, right? So whilst this candle is actually going to break this low or to violate this low, we are expecting that move to be issued in this particular arrangement, whereby the smaller time frame, the M15 time frame, will be actually issuing an accumulation, a manipulation, and a distribution. Our entry, or we would like to make our entries within this distribution phase to end this flow at the previous daily liquidity zone. In short, this is called the AMD. The market starts by accumulating, then manipulates, and lastly distributes towards the daily time frame liquidity point, basically like that. So we are saying whenever we see a candle, let's say this is a candle, a daily candle, and then this following candle breaks this low, right? It breaks the low. We expect the third candle, right, to break this low. So since we are in that anticipation, we want whatever processes that are going to be issued in this third candle to follow the accumulation, distribution, and the accumulation, manipulation, and distribution, and take out this low as our target. Let's now go over the charts so that we can fully understand this concept in depth. So this is NZD against US dollar. So on NZD against US dollar, we can see that there are these three candles and this is the current price. What we want to do is to mark these highs so that we can see this was the high of this particular candle. Then we had this as the high of this candle. So we want to see the operation of the market within this candle so that we can actually take or reach this high, since we've said if these two candles if this candle breaks the high of the previous candle, we expect the third to break its high. What we are just saying is this is the low, right? This is in this red candle, we had this low. We can see this particular candle violated this low, meaning that we are expecting the third candle to violate its low, which happened here. So within this candle, the AMD arrangement is supposed to be seen for us to make use of this particular flow. All right, so after having this, we now have a target for this particular current day. So since we have a target, which is this one, where could have been our entry located? We now go to the M15 time frame. First, let me demarcate the days so that it will be easier to see. This is this day, and this is this particular day, and 3 days like this. If we go on the M15 time frame, so on the M15 time frame, this is how it looks like. We have seen this is the target that we want to reach, and from that target we want to enter the market with the AMD scenario, or the power of 3. We can see that we had the manipulation that occurred here, right at the open of the market. Then after that we had this particular manipulation, so accumulation, manipulation, and then distribution. We've said we want to participate within the markets, within the distribution, so that we can fulfill the move to the target of the previous daily liquidity zone. So within this distribution, you can see that there is clear accumulation, distribution, accumulation, manipulation, and then within the distribution, we want to find reasons of market entry, and these include 1, order blocks, which we will talk about in the future videos, of course, and 2, we want to also talk of fair value gaps. So in this particular case, we can see there is this particular fair value gap and there is this particular fair value gap. Of course, we would love to have these the market to come to the discounted fair value gaps, but in this particular instance, we can see that the market gave us concrete signs that it's going to respect this fair value gap since it retested twice. I always want to see the market to pull back to the discounted fair value gap like this one, but in this case the first one could have been something that you are going to ignore. But when we retest that same fair value gap before we have hit our target, it's actually a powerful fair value gap. So in this particular instance, we want to long and our stop loss right below the last low, and then our target at the yesterday's high, which is our previous daily liquidity zone. So this is an entry we could have made using this particular concept. So all that you need to do is to determine the daily liquidity point and then come within the current day and see or look for the play out of the power of 3. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.